Um, Thank you for inviting me. I'm going to talk about the supply-side origins of inflation. When I practiced this talk at ASU, Gustavo Ventura, my Argentinian colleague, said you're only allowed to call it the supply-side origins of inflation, because clearly in Argentina there's very other origins of inflation that I'm not going to talk about. So what I'm going to do is basically I'm going to do three things in this talk. I want you to think beyond demand-driven business cycle fluctuations. And I teach principles at the ASU. If you want, you can take this course. It's a massive open online course. And we tend to teach monetary policy a lot in terms of demand shocks. But I really want you to start thinking about correlated demand and supply shocks that erase the output inflation trade-off. And there's a discussion on this making the Phillips curve disappear, just like we teach stagflation. But really, that doesn't mean that there's no monetary transmission mechanism, but I think I want you to think a little bit more about the supply side effects of monetary policy. So I'll discuss that. And then once you start thinking about the supply side effects of monetary policy, then it's important to think about how do you account for the supply side factors that drive inflation? And that's what is basically the core of this paper. So what I'll do is, I'll do a dual growth accounting exercise where I'm just going to compose PC in terms of the different costs that are driving inflation in the United States. And in order to do that, you have to decompose the value chain that composes personal consumption expenditures, the stuff that households buy. And when I do that, I find that the value chain has not changed a lot over the last few years. What turns out to be very important for inflation is actually the prices of imports and the value-added deflator of mining, but that's all oil price and commodity price driven. And that together actually drives 3/4 of the variance of inflation in the United States. Now this is headline inflation, not core inflation. But I find that quite remarkable, something I did not expect when I started doing this analysis. And then I'm doing this using growth accounting data that gets released with a long delay. The data that I use was released last year, and it covers through 2015. Now, if you're a monetary policy maker, that's a little bit long to respond to. I mean, I know there's lags to monetary policy transmission, but we don't think of them as 3 or 4 years. So the other thing that I wanted to show you here is that even though you can do this analysis only with a delay, there are some simple real-time rule of thumb approximations you can use that can give you some sense of what these different supply factors actually do and how they affect inflation. And then finally, I'll talk a little bit about the limitations. Some of them have been mentioned. Jordi mentioned markups. I'm going to use a neoclassical growth accounting framework, so they don't really take into account markups. They show up, though, and so being more specific about them is important going forward. And then this analysis is done for the US, where we're lucky that the BLS and BA have constructed the data set that allows us to do this. But I think one of the things to take away from this is this is useful to do in many other countries, but data limitations are in the way to some extent. So let me start by talking about thinking beyond demand-driven business cycle fluctuations. So I'm referring here to Blinder. He had a Wall Street Journal article that I liked about the Phillips curve being dead. So, well, really what's going on is we don't really have a clear evidence anymore that there's a positive output inflation trade-off in recent data for many countries. And that's kind of disconcerting in some sense, because it seems that we're not really moving an aggregate demand curve along a relatively shift aggregate supply curve. So one way to think about this, there's other ways to think about this, but one way to think about this is really think about it as correlated demand and supply shocks. So here's a plot of the inflation rate that I'm going to look at, which is the solid line. It's the PC inflation rate in the United States. I also plotted the CPI in the United States, which is the consumer price index. They move together a lot, so I won't talk about the technical details. And then the third one is CPI here in Chile, which moves more, but it's actually moves around the relatively constant mean, which is I guess a very big success from a monetary policy point of view. And it also moves more because, of course, the Chilean peso is not the international reserve currency like the dollar is, so there's other pass-through effects that we don't really face that much in the United States. Now, here's inflation that was really high during the Great Recession. If you look at output, here's GDP. I'm not going to make any assessments on output gaps or anything. I'll leave that up to other people to do, like Matteo already did. But I wanted to say a couple of things about this. One of the, of course, the biggest thing that you see is we think of output going, you know, the textbook version is output just fluctuates around a constant trend. But at least the Great Recession, but even to some extent the recession of 2001 in the United States is more like a step function where we are actually not going back to the previous trend anymore, but we're actually seem to be going to a lower trend. Now, this is actually true for many countries that go through financial crises. It's not only true for the United States. It's been true for Sweden and for Korea and other countries that have gone through financial crisis. And it's true for a lot of countries, actually, after the financial crisis. But that suggests that there's something else that's bumped output down relative to its previous trend path, and that, to some extent, can only be explained as a supply shock. So that's why it's worthwhile thinking about a supply shock as well in this context. So here's the way that this would work in a standard kind of textbook macroeconomic principles class. I'm plotting here a short-run aggregate supply curve. Fortunately, it's upward sloping. Otherwise, there's very little room for monetary policy to do much of anything, even if it manages the demand side. And the textbook case is on the left, where basically you have a target inflation rate, demand shifts down along the short-run aggregate supply curve, but the short-run aggregate supply curve doesn't move a hell of a lot. And as a result, inflation goes down and output goes down. They move in the same direction. There's a positive output-inflation trade-off. The central bank can stimulate demand and move the demand curve back to its previous level. So now think about a world in which there's a recession, like a financial crisis, where credit is constrained, with a working cost of capital, the cost of working capital is going to go up. That actually doesn't only have an effect on the aggregate demand curve, it also causes an inward shift of the short-run aggregate supply curve. Now, in that world, you wouldn't expect much of a decline of inflation. I've plotted it, obviously, in the perfect case, where there's no decline of inflation. It also means that once you stimulate the economy, both in the supply and the demand side, the path of inflation back to equilibrium actually depends on the relative speed of adjustments of the aggregate demand and aggregate supply curves back to its previous level. So once you start thinking about the downturns, especially the Great Recession, not being solely driven by demand shocks, then you can actually understand why a Phillips curve might have flattened in the data or even been non-existent. Now, this is a textbook case, so let's go to a simple academic model that many people use. This is the three-equation New Keynesian model, the standard one. And if you only put demand shocks in there, it looks perfectly like a positive output inflation trade-off. You're going to have the output gap is, inflation is high when the output gap is positive, basically. Now, once you have correlated shocks, correlated demand and supply shocks, this is the right diagram, there the correlation is a half. You actually can get a negative, what we call a sacrifice ratio, even in this data empirically in this model. So once you put correlations in between the demand and supply shocks in this model, you're basically getting no output inflation trade-off. That's not very satisfactory to have correlated shocks. I mean, Valerie Ramey has a very nice handbook chapter on shocks where she basically says correlated shocks is like an oxymoron. So what then if we think that the shocks we have in our model end up being correlated? Well, that poses several challenges. And they're basically, you can split them up into three types of challenges. First of all, we have a theoretical challenge, which is what are the common sources that move those shocks around? What are they? Like credit frictions would be one, for example. I cited 4 papers here that each of them have a slightly different mechanism. One is actually related to what Simon's going to present later on today, but there's other mechanisms as well. What is true is that many of the papers that actually introduce these mechanisms don't put it back in this old textbook framework that is actually useful to think through because we think through this on a day-to-day basis kind of when we talk about monetary policy. And that brings me to the second point, which is on a policy point of view, if you think there are substantial supply-side effects of monetary policy, for example, through alleviating credit frictions, things like that, it's important to communicate that. And we do very little of that. There's still a lot of monetary policy speeches by monetary policymakers that talk about aggregate demand's high, aggregate demand is low. I haven't cited them here. I found them in preparation, but I didn't want to point at specific individuals. But this terminology is still used a lot. But, really, if you think there's major supply side effects, that's probably not the right way you want to communicate the effect of monetary policy. Now, if you think there are supply-side transmissions of monetary policy, then you're also having this the situation that if you talk about maximum employment and price stability, which is the mandate of the Federal Reserve, there's not necessarily a trade-off anymore because it depends on how the shocks are moving the economy around. Now, those are all kind of pie-in-the-sky thoughts about monetary policy. So let me get into more of the details and the weeds here. I'm a measurement guy, so let me focus on the third challenge and improve our understanding of the supply-side origins of inflation. And what I'm really going to do is this. I'm going to use growth accounting methods to account for the cost factors that drive inflation from the production side of the economy. And growth accounting methods are used a lot, also by policymakers, but mainly to assess long-run growth patterns and potential output. So what is new here is that I'm going to focus on short-run fluctuations in PCE, actual annual fluctuations. I'm going to focus on PCE, not GDP, so I'm going to focus on consumption, not on output. And thirdly, I'm going to focus on the price. That's why I'm doing a dual growth accounting method, not on the quantity. So I don't want to show you a whole bunch of math in 35 minutes because I don't think that's going to be very worthwhile. So what I'll do is I'll show you kind of diagrammatically what I'm going to do. When we look at the basket of PCE goods, think of that in the upper left corner. We split them up into different commodities, different things that people buy. And then what we generally don't do is we can think about which industries produce those commodities, or are they, and which part of those commodities are being imported, which part of the cost of these commodities comes from abroad. Now you can trace this out using input-output analysis. So those are kind of the steps you can trace out. Then once you have which industry produces which part of output, you can actually split that up between the factors that produce output, so capital and labor. And for that, you use productivity data. And that's the arrow that goes from the middle rectangle down. So let's do it step by step. If you actually, the split up of PCE commodities, PCE in different commodities is directly done in the national income and product accounts in the US on a quarterly basis. And in fact, you can also find out the contribution of each of the prices of these commodities to PCE inflation. This is reported in table 232. And people use this data. I think Larry Ball is going to use some of that when he does median inflation. The San Francisco Fed publishes a distribution of inflation rate across this table. So there's different ways of doing that. But what I'm going to do is I'm going to trace this back a few steps up the supply chain and figure out which industries contribute to the cost of which particular goods. So let's just start off by industries and imports. And this is kind of what we sometimes call the domestic and the foreign requirements for US personal consumption expenditures. And this is standard derivation using input-output analysis. And what I want you to take away from that is this. There are really no major shifts in the US PCE supply chain. The domestic requirements for $1 of PCE spending have not changed much by industry. There's a slight change in import requirements, but it's not enormous. So here's a table with a lot of numbers. Unfortunately, the screen is big, but I don't really want you to take away every number. So I highlighted fire, finance, insurance, and real estate. This table contains basically on $1 of PCE spending, which industry, the cost can be traced to which industry or to which type of import. And if you look horizontally at all of those rows across different periods that are plotted in the columns, these things don't move a lot. Now, I do want to say one thing. This is based on input-output tables that aren't released very frequently. They are interpolated in the data by the BLS and the BA. So some of the fluctuations in these shares, their relative constancy might be a function of the way the data is constructed, but it's the best data we have. So, although the Census Bureau in the US is actually working on a survey that should improve this data. Now, but when we split up, the top part of this table is done by value added of different industries. When we split this up by different factors of production, so capital and labor, then we're going to get the cost shares of different types of factors of production in PCE. And the one thing that shows up in the data, which is something that many people studied, is basically a decline in the labor share. In the context of this paper, it's called the factor requirement of labor. In the US, this is driven solely by non-college educated labor. So this table plots the domestic requirements, but then split up by the production factor. So it shows that of every dollar that people spend on PCs, let's take the last number on the row labor total, 48.9. It shows basically on average, 48.9 cents on the dollar spent on PC spending in the US is going to labor. 24.9 goes to non-college, and 24 goes to college labor. But if you look at the college and the non-college trends, they're going in the opposite way. Non-college labor has declined from about 29% to 22%, while college-educated labor has gone up from 22.8 to 25.2%. What we're seeing in the US is largely reflective of wage growth not being high for non-college educated labor, and we're also seeing a labor supply effect where people who have no college education actually drop out of the labor force. On the capital side, there's not an enormous change. The share of capital is relatively flat in the data. Here's the time series of them, and I've also added imports to it. And as you see, these things are relatively constant. Basically, imports are about 10%. It's gone up a little until the recession, then it went down a little. But imports are around 10% of PCE. And then labor has been a little bit above 50, now it's a little bit below, and the rest is capital. No major movement, slight upward trends. But for the measurement of inflation, these things are kind of second order, these movements, these trends. So now let's talk about inflation. And first, I want to talk about fluctuations. What causes inflation to fluctuate? At the end, that's what's important for a central bank. So I wanted to focus on that first. So remember that inflation is basically a weighted average of the price changes of the underlying costs. So that's what I'm going to do here. I have the weights. I showed you those nominal weights. I'm now going to show you basically those weights multiplied by the price changes. And when I look at how different sectors contribute to inflation, you're going to get the following pretty dramatic result. This is all the sectors that I have in the data, plus the imports on the bottom row, and this is their contribution to the variance of inflation in the United States. And what you're finding is that imports, even though they make up 10% of the basket that makes up inflation, imports actually account for 45% of inflation fluctuations. And then mining and utilities, imports is largely oil, and mining and utilities, which is also commodities and oil, mainly oil and natural gas in the United States, they're also contributing another 30%. So the two of them together contribute 3/4 of the variance of inflation in the United States. Now, we don't think of the US as a commodity-based economy like Chile is in large ways, but in many ways, the variation in the headline inflation rate that the Fed targets is largely driven by commodity prices. So then the next thing we can do is, again, drop the imports for a second. We don't know which workers and machines abroad contribute to the cost. So let's only look at the workers and machines in the United States and look at which of those contribute to these bars on top. So these are the domestic factor contributions to inflation fluctuations. And here a couple of things stand out. Capital and TFP are important, and they move in opposite directions. Largely, that is markups, actually. So some of the TFP measurement you do with neoclassical growth accounting is actually capturing markups rather than technology. And then the other thing that is remarkable is that if you actually look at the labor part of it, college-educated labor contributes much more to the variance of inflation than non-college educated labor. Their wages tend to move much more. And that comes back to a question Matteo was asked. In some work that I did with Aisha Goshahin and Mike Elsby when we looked at the labor share, what we found was that the sectors that pay a lot of variable pay bonuses, finance and real estate, and tech, those are the sectors that drive a lot of the movement in the labor share in the economy and compensation per hour. So this largely seems to be a variance in bonus pay that gets captured in compensation per hour in the United States. There's a few measurement problems with that. This data gets released late and compensation per hour gets revised a lot, but that's largely reflective of that. So at the end, the flexible margin in wages in the United States largely seems to be variable pay for college-educated workers. So The final thing I want to do is I'm going to show you a plot. I've shown you the variance and not the level, which is kind of a weird sequence to start with the variance and then the level. But the results on the variance were more striking. So now let me show you the level contributions. What I'll do is I'll do it by the factors of production, and then I'll also put the imports in it. So here's the four contributions to annual PCE inflation. These four lines add up to headline inflation, annual headline inflation in the United States from 1999 to 2015. So there's a couple of things to take away from this. Remember that imports are 10% of inflation, and capital is about, it's about 40%, and labor is about 50% of the weight in inflation. Now, what you're seeing here is that the dashed blue line, the imports line, which causes a lot of the variance of inflation, and it moves because it co-moves a lot with inflation, it's largely due to the big swings in oil prices that you're seeing here. This sample ended in 2015, another year where the oil price was going down. I guess that was previously referred to as the commodity price bust. So. Now, the red line here is the TFP. TFP generally contributes negatively to inflation because if we get more productive, we can produce goods at a lower price. So dual growth accounting would reflect that as a negative contribution. So a shift up in TFP is actually that TFP, so the shift upward contribution in GDP is a slowdown in TFP growth, that's the red line. And then when you see this big decline in the Great Recession, or in 2010 actually, it's not the Great Recession, it's at the end of the recession, what this reflects is that the actual PCE prices declined faster than the costs, than the weighted average of the costs that go into PCE. And so that's reflective of a markup shock. And you can see that because it contributes then, it's attributed to capital in this plot. And finally, the labor contribution is, was about 1.5 to 2% before the recession, and it's been hovering about a percentage point lower afterwards, reflecting much slower wage growth in the United States since the Great Recession. Not only in the United States, many other countries have seen that as well. So this is the kind of and so what you could do, for example, if you're policymakers, to say, let's take the effect of import prices out of PCE inflation and just subtract this blue line from PCE inflation and look at kind of more the domestic factors that drive inflation. Now, the problem, of course, is you would like to do this in real time, but you can't do it in real time because you're using growth accounting data that get released with a delay of several years. So for that, you need a real-time rule of thumb. And I want to show you a couple of these approximations. This is not high-end econometrics by any means. It's just taking some linear combinations of the variables I put in. But I was surprised how well this works. So here's the import contribution to PCE inflation. It's very well approximated by basically taking a linear transformation of import price inflation from the national income and product account. So the solid line here is the actual contribution that I measured and I showed you in the previous diagram. And the dashed blue line is just a linear transformation, 0.10, and then you do also, basically that's the weight that I found before, and you do an adjustment for the mean as well. And then you basically find that import price inflation, this transformation for import price inflation really closely matches the contribution of imports to PCE inflation in the United States. So it's something you could do in real time. You could just subtract this from PCE inflation and say, hey, that's kind of left from the other factors that drive, other cost factors that drive inflation in the United States. So I was excited to find this, especially because this is such an important component of inflation. It really it contributes so much to inflation, and we basically don't even put this in most of our models. Most of our models don't have exogenous commodity price shock, so you kind of want to filter that out when you look at the data. So the next thing that I thought was pretty cool was that the TFP contribution to personal consumption expenditures actually can be approximated very well by a TFP growth measure that John Fernald releases quarterly at the San Francisco Fed. So here's John Fernald's measure transformed, and And again, I think what I'm learning from this related to the question about markups is that a large part of the TFP measure that John Fernald publishes also reflects markup movements. He does a utilization adjustment of it, but not a markup adjustment of this. And this seems to be largely reflecting some movements in markups as well. And then finally, labor costs, which is actually something I've looked at more in detail. So that's why I'm plotting 4 time series here to really confuse you. But the solid line here is the actual contribution that I found from the data that I showed you before. And then there's 4 different compensation measures in the US. They contain different types of variable pay, different types of self-reported earnings or administrative earnings. There are many different ways of measuring compensation growth. There's a nice paper actually by Giustiniano, Primiceri, and Tambalotti who say that what you could do is just actually put them all in your measurement equations in a state space model, which I like a lot. But here I just plotted all 4 of them to show you kind of, this measure is constructed largely based on compensation per hour measures, which is the purple long dashed line in this plot. But what this measure does is it does a quality adjustment. That's what growth accountants do. They want to make sure that in certain years, the workers are of different quality. They have different, so they actually adjust for the compensation of education, age, and gender. And so what happens if you do that? I did this quality adjustment as well for compensation per hour. So compare these things here. What you're seeing here is that the actual wages that go into PCE are a little bit more pro-cyclical than the wages in overall GDP. So we're using measures that look at all workers. We can't really distinguish which worker makes consumption goods and which workers make, we could take non-farm workers out, or farm workers out, we can take government workers out, but it's hard in the private sector to distinguish between workers that make consumption goods and investment goods. So what we're finding here is that inflation is actually more wage growth, the contribution of wage growth to inflation is more pro-cyclical in this growth accounting data than it is in the macro measures that we normally use. And that suggests that the workers in the consumption goods producing sectors in the economy actually face more pro-cyclical wage growth than workers in other sectors in the economy. It's not surprising. We were talking about unionization of government workers. That same is true in the United States. And again, the unionization rate of government workers is declining and their bargaining power is also declining. But overall, they would probably face, they're more insured against business cycle fluctuations through the wage negotiation that they're subject to. So the disappointing thing is it's harder to approximate the wage contribution through wage measures. That leaves a nice research agenda that I hope to contribute to in the future. But then I wanted to end up talking about extensions. And basically, there's 2 things to think about here. The first thing is, I hope that this shows you that you could use growth accounting, which we generally associate with productivity, to actually apply it to short-run inflation fluctuations and get some really useful insights in the sources of inflation fluctuations. But that then also means that, once you use those techniques, you run into the same limitations as growth accountants do. And one is that it solely relies on neoclassical assumptions. And those include, no markups, perfect competition, things like that. Now, clearly, our theories of monetary policy transmission are exactly based on the fact that prices are sticky, and it can only be true if there's imperfect competition, because otherwise the firms with the sticky prices or the higher costs through the sticky wages will be competed out of the market by the ones that can adjust their prices. So for monetary policy, it's important to think through deviations from neoclassical assumptions. And then the other thing that is important, I think, is to think a little bit more through the data side. So let me kind of summarize this in the following slide. The first challenge is to really think about growth accounting with deviations from neoclassical assumptions. There's an old literature on this. Bob Hall started the literature on this. And there's also a recent paper by Emmanuel Faria and co-authors that tried to do this. But it's crucial, I think, if you want to understand supply-side factors and how they drive inflation, because you really want to get a better grasp of markups. That turns out to be hard, though, because it depends on what your model of markups is. and there's a discussion in recent literature about on a paper by Jan Eekhout and Jan de Loecker, where it turns out it matters a lot what you assume is overhead cost and what you assume is variable cost for markup calculations. That's also true, by the way, if you do growth accounting, because the cost measures that I have don't distinguish between fixed overhead cost and variable cost. We assume that they're all part of variable cost. Then what's also important, I think, and what's nice about an analysis like this is that you can actually see where these markup fluctuations are most important. And it turns out they're most important in mining and utilities. And there you can see that pumping oil out of the ground or digging copper out of a mine, the cost doesn't vary as much. The price goes up a lot, goes up and down a lot, so you can see how markups fluctuate a lot just with commodity prices. That's a very different model of markups than a model where you do strategic price setting under nominal rigidities, because you're basically still a price taker in the international commodity market. And then finally, so that's on markups. And then finally, I think, and I want to really emphasize this here, is that it's been a bit disappointing if you look at cross-country data that actually there's been really good efforts at the OECD as well as in the European Union, not so much from the United States, to collect internationally comparable productivity data, to collect internationally linked input-output tables that will help us understand supply-side factors and supply chains for global value chains on a global perspective. There's the World Input-Output Database, and there's also the OECD STAN database. The OECD has done a remarkable job with this. But funding for these things have kind of dried up. And this is true in the European Union. It's also true kind of that there's been hesitance in funding the OECD in general. And that's really unfortunate because especially for a smaller economy like Chile, or for that matter, I'm from the Netherlands, for an open economy like the Netherlands, having this internationally linked data that allows you to really figure out how the global value chain is contributing to the costs of the goods and services that consumers buy is going to be very important to actually understand what supply-side factors are driving inflation. So I really want to emphasize that I hope that anyone who has influence here over funding related to that will put a good word in for these data sets that are not only important to analyze productivity and long-run trends for budget forecasts, but they're actually also very useful to analyze inflation fluctuations. So in case you walked in a little late, but no one did, so I can just skip this slide, I want you to think beyond demand-driven business cycle fluctuations and really think about why can the Phillips curve fall apart? Well, basically because sometimes there's periods where both the demand and the supply curve shift inwards. Now that doesn't mean that monetary policy doesn't have an effect, but you have to communicate then also how monetary policy is transmitted more through the supply side of the economy. Once you think that is important, you want to account for what cost factors drive inflation and what are those. And that's possible using growth accounting methods. And when you do so for the US, you get the results that I just showed you. But it's harder to do this for other countries. And it's also true that an analysis like this is subject to the limitations of any growth accounting method. What I ended up with when I did this whole analysis was that I knew inflation fluctuations in Chile were driven largely by commodity prices and by pass-through and being Dutch, sitting on a big bubble of natural gas, I'd seen things like that before. But I was surprised when I did this analysis for the United States, how much of the variance of inflation in the United States is actually driven by similar factors and by similar international commodity prices that the Federal Reserve has some influence over maybe, but not a whole lot. Thank you.